You open a stock chart and encounter a sensory assault. RSI lines cross, MACD histograms flash, and moving averages weave through the candles. Many traders look at this tangle, trying to predict where these lagging indicators will cross next. This often leads to reacting to market noise rather than the price itself. Stripping away these secondary layers reveals raw price action. This clean chart provides a real-time record of the transaction history between buyers and sellers. It tracks exactly where capital moved and where market participants reached a consensus on value. To find predictability in these movements, we analyze the smallest unit of data, the individual candle. Every candlestick records 4 data points: open, high, low, and close. The thin wicks extending from the solid body represent temporary price excursions. A long upper wick indicates buyers tried to drive the price higher but were forced back down by selling pressure. The relationship between the solid body and these wicks creates identifiable patterns. For instance, a long bottom wick with a small body is a hammer, while a candle that completely covers the range of the previous one is an engulfing pattern. These shapes show which side gained momentum. A hammer appearing after a significant drop suggests that selling pressure has subsided and buyers have begun to re-enter the market. Each closed candle serves as a completed data point. When we view them in sequence, they reveal the shift from micro battles to broader market trends. Zooming out reveals the broader structure of the market. According to Dow theory, an uptrend is defined by a consistent sequence of higher highs and higher lows, showing that buyers are willing to purchase at increasingly higher prices. Conversely, a downtrend consists of lower highs and lower lows. This structure indicates that sellers are in control, and each attempt at a recovery fails to reach the previous peak. Within these trends, we see the formation of support zones. These are price levels where historical buying volume has been strong enough to halt decline. Resistance zones are the opposite. Ceilings where selling volume has historically overwhelmed buyers, preventing the price from moving higher. These levels frequently switch roles. When the price shatters a support floor, it often becomes a resistance ceiling. Traders who bought at the floor sell when the price returns just to break even, creating new selling pressure. These trends and zones represent the aggregate behavior of millions of participants. They provide a structural map of where orders are likely to cluster. While retail patterns provide a map, the market is primarily driven by massive financial institutions. Because they manage billions of dollars, their trades are too large to be executed instantly without significantly moving the price. Smart money concepts is a framework used to identify the specific locations where these institutions have committed significant capital. Institutions leave marks called order blocks and fair value gaps. When a bank places an order too large to absorb, it creates a massive disproportionate candle. The empty space left between surrounding candles is a fair value gap, an imbalance the market often fills. Large institutions require massive liquidity to fill their positions. They often find this liquidity near clusters of retail stop losses. This is why the price often appears to target specific lows or highs before reversing sharply. By identifying these institutional zones, traders can find high probability entries. Instead of guessing a reversal, they wait for the price to return to a fair value gap where institutional orders are likely waiting to fill. Recognizing these footprints allows a trader to align with the dominant momentum of the market, rather than being caught in its wake. Let's apply these concepts to a live chart. We start with the macro context, noting a bearish put/call ratio, which indicates a defensive sentiment among large-scale investors. The chart structure confirms the sentiment. We see a clear downtrend defined by lower highs and lower lows. The price breaks through a major support level, creating a structural shift. This aggressive move leaves a fair value gap right at the point of the break, marking where institutional selling was most intense. Now we look for a secondary confirmation. An exponential moving average is sloping downward, perfectly intersecting with our institutional gap. With the structural trend, the institutional gap, and the moving average all in alignment, the probability of a decline is high. A short position is opened as the price tests the gap, followed by a rapid drop as the trend continues. Effective trading relies on the alignment of multiple pieces of evidence. By analyzing the mechanics of price action, you can trade alongside institutional flow with much higher clarity.